We have talked about ordinary income, which we know it is subject to a marginal tax rate. Let's talk about capital gains and losses. Why do we need to know about it? Because it is subject to a different tax rate. So let's dive into it. Capital gains and losses are profit and losses that's generated from the sales of a capital asset. It seems very simple, but what is a capital asset? A capital asset can be like stock investment. For example, if you just buy an Apple share, a Facebook share, or Google share, that is a stock investment. If you buy bonds, real estate investments, or if you have an interest in the partnerships, all these are capital assets. If you have any gains or losses that is generated from the sale or any transaction from these capital assets, then the gains or losses are called capital gains or losses. We need to distinguish the short-term and long-term because it has different tax consequences. The short-term capital gains or losses are defined as any capital assets that you held for only 1 year or less, and any income or losses that is generated from that will be considered short-term. Long-term is basically any capital assets that is held for over a year, and the gain or losses we'll call it like long-term. And we'll talk about why it's important to distinguish long-term and short-term. Capital gain, short-term capital gain is treated as ordinary income for individual purposes, which means, as we learned previously, it is subject to the marginal income tax rates. For long-term capital gain, it is subject to a long-term capital tax rate, which is lower than the marginal tax rate, as shown here. For a single person, if your income level is around 40,000 or less, you will subject to no long-term capital gain tax rate. If your income level is slightly below 40,000 and under $434,000, you'll be subject to 15%. And then anything over $434,000 is subject to 20%. And this is similar to marginal tax rate got adjusted annually as well. So if you compare back to our slide for marginal income tax rate, you can see that we have a much lower long-term capital gain tax rate. It's 0%, 15%, and the highest is 20% here. So the takeaway here is that you would prefer capital gain tax rates rather than marginal tax rate. To the extent you can pick, you would want the income to be classified as long-term capital gain rather than short-term capital gain or any ordinary income. However, it may not be something they can control, but understanding the rules may help you know what you can do to generate what type of income. What we did not talk about here is that what happens if you have a short-term capital gain and long-term capital loss? How does it work? Since we are not a tax class, I'm not going to go too much details on the technical, but on a higher level, you should net the capital gain in the same nature first. For example, if you have a short-term capital gain and short-term capital loss, you net that two first, and then if you have a long-term capital gain and long-term capital loss, you will net two first. And then if you have an overall gain, then that will be subject to tax. If you have an overall loss, for example, a short-term capital loss, you can only deduct 3,000 each year, and then any additional or remaining portion that you will be able to carry forward to next year that you can take a decision going forward, but not in the current year. This is something that you can make note of, but we are not going to dive into it too much details.